Something interesting I learned about earnings per share is that it's very useful in investment ratios, because when I invest in something, I want to know how much I'm going to earn per share, right? So when we look at a RIM stock, we see the quarter earnings per share and yearly earnings per share, and we can deduct from that how much our money is going to come back to us from the profit.
I did book value per share. I found it interesting that Warren Buffett and Benjamin Graham, two of the wealthiest investors in the world, believe that book value per share is more useful than earnings per share, as Rocky was doing, because it's harder to change and cook rather than earning per share, which is easily changed if the company wants to cover up something.
I found it interesting that companies that do not pay dividends aren't necessarily without profit. Another interesting fact is that investors look at electric utilities and tobacco companies because they're good sectors with companies that have really strong dividend yields.
Even though price-earnings ratio can be an extremely useful tool for investors, it does have its limitations. For example, a firm can easily manipulate its stock price through a stock split or a repurchase program, so it's really good to go beyond just this ratio when investors are looking into investing into a company.
What was really interesting about market and book ratio was the fact that you can't solely depend on what it is, if it's high or low, because if it's low, it could mean that the company is undervalued, which is good for investing, but it could also mean that it's doing really poor against its competitors. Or if it's high, it could be that it's overvalued or it's doing great against its competitors. So you gotta look at the market book ratio and other ratios to be able to make a concrete statement if it's a good company to invest in or if it's not.
And I found out it's actually very important because if a company has poor cash flow and they're making a lot of money, it's still pretty bad, because even though they're making a lot of money, they have to use a lot of that money to pay off some of their expenses. So if they have good cash flow, that means the company's really good and the chance of bankruptcy is pretty low.